Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, as you saw in the title, the topic of today's video is when should you sell a stock? And I'm going to just say up front that selling a stock is a much more difficult and complicated topic, I find at least, than buying a stock. There are several reasons why you may want to sell a stock, which we'll talk about today, but there's really only a couple of reasons why you'd buy a stock. You understand the business and what those cash flows are likely to be out of that business in the future, and you can buy it at an attractive price. That's basically the checklist for buying a business. Selling can be much more complicated. There may be reasons that you want to sell because the price has shot up a lot. There may be reasons that you want to sell because you're wrong on the business. And those are some of the things that I want to talk through today. So let's get into it. Now, first off, I just want to get into one reason why I would never sell a stock, and something that I think is a ridiculous reason to sell a stock, because it really doesn't align with the strategy or the way I think about investments. And unfortunately, it's a reason I see a lot of people often selling, and I think it's most of the time a massive mistake. So the number one reason I see a lot of people selling, which I think is just a stupid reason to sell, is they think the market's going to crash, or they think the price of the stock is going to go down just by looking at a chart or based on recent price action. So first off, that's a terrible reason to sell a business. The underlying value of a business is what is really important. What is the intrinsic value of a business? How much cash can that stock or that business return to you as a shareholder over the lifetime of that business? That is fundamentally what matters. And if you think that a business is worth $1, you can buy it for 50 cents, and then you see all the speculation in the market that, the market's probably going to dip 10% next week because of XYZ reason that some news reporter is speculating on. That is not a reason to sell your business. You have got a fantastic deal in that investment, and just because you think the overall stock market is going to move around, that's a terrible reason to sell, in my personal opinion. So I just wanted to get that one out of the way. And now let's get into some more fundamental reasons why you might want to consider selling. Now, firstly, I want to go through the scenario where an investment thesis that I have plays out basically perfectly to plan, and the situation under those circumstances where I would consider selling. So firstly, just a brief overview of my investment strategy, if you haven't watched the channel before, is basically I'm looking to identify the intrinsic value of a business based off its likely future cash flows, and then I'm looking to buy that business at a significant discount to intrinsic value. So if I think something's worth $100 and I can buy it for $50, then I will go ahead and make that purchase. Now, let's say I've got an investment where I've been able to do that, and I have largely been right in my analysis that that business truly is worth $100, and I got a great deal. I bought it at half off at $50. Now, basically in that scenario, what I do is I wait for that company to appreciate to at least 90 cents, but ideally more like $1 on the dollar. So no discount to intrinsic value. And when it gets to that point, really, I have a decision to make. So I have to either sell that business because it's appreciated to intrinsic value and my investment thesis has played out, or I can continue to hold that business. And there is basically a few different factors that are going to influence my decision there. So the first one is the type of business itself that I'm invested in. So the reason I say that is there's basically two kind of styles of business that I will purchase into. The first one is a growing pie. So I purchase something that I think is worth $1 and I can buy it for 50 cents. And maybe in 2 or 3 or 4 years' time, when it has hopefully appreciated to intrinsic value, that dollar is now actually worth more like $1.20 or $1.30. If I've got an investment in that bucket, I am going to be much more likely to hold that business even when it appreciates to intrinsic value, especially if I have no other businesses available, no other investment opportunities that are newer, that I think are big discounts, and I can kind of shift that money across. So if I am in one of these compounders, one of these growing pies, and I basically don't have any other opportunities to shift that money across to, I'm probably going to continue to hold that business because the alternative at that point for me is to sell it and hold cash. And over the long term, I expect high quality businesses that grow and compound wealth over time. I expect that to perform much better than cash. So if I have one of these compounding businesses and it appreciates to intrinsic value and I don't have anywhere better to put the money, I'm going to continue to hold it. If I do have somewhere better to put the money, I'm probably going to sell that and move it into that new investment. Now, the second type of business that I'll buy is I'll buy a piece of the pie that is not growing. And these are businesses that I try not to invest in if I've got growing pie sort of opportunities, but every now and then they can get really, really attractive. You can buy something worth $1 for 30 or 40 cents, and that can mathematically work out very, very well over the next few years if that 30 cents appreciates to $1. So that's sort of the second type of business that I will buy into, and basically this equation is much simpler. So once that gets to 90 or 100 cents on the dollar, it's an instant sell for me. So the reason for that basically is, again, my alternative is cash. Now, if I sell the business when it's worth $1, and it also has a market value of $1, so price and value have kind of aligned at that point, what I personally have to look at is what happens if I continue to hold that business over the next few years. And if that business is worth $1, it's probably not going to appreciate to $1.50 and get substantially overvalued at that point. So it is quite likely that cash is an equally attractive investment at that point in time. So even if I don't have a new equity investment or a new stock that I can move that cash across to, I'm probably likely to sell it anyway. Because I am basically taking on the risk of holding a business and all the things that come along with owning a stock for really no fundamental benefit at that point. So if it's a simple something that's worth $1, will always be worth $1, and I can buy it for 50 cents and it appreciates to that, I'm just going to sell it basically regardless. That decision tends to be a lot more simple. Now, the other situation where we might sell a stock is when our original investment thesis has not worked out as expected. And a great example of this is Warren Buffett with his airline investments. Warren Buffett went ahead and sold his investments at a loss. And I want to kind of run through how he came to that decision, because selling at a loss is obviously not something we want to be doing particularly often, but there are certainly some good reasons to do that, so let's get into that. Now, firstly, I think it's important to understand with this particular example what Warren Buffett's original investment theory was with the airlines. And his investment theory basically was that he was paying roughly 7 or 8 times the long-term cash flows, long-term earnings that he expected to get out of those airline businesses. So airlines are notorious for having very lumpy earnings. They're basically highly leveraged to the price of oil and the price of fuel. They can be particularly cyclical, so there were going to be big swings, big ups and downs with those particular businesses. But over the long term, if you look at, say, what those businesses are going to earn annually on average over the next 10 or 20 years, Buffett was probably paying about 7 or 8 times earnings, something like that, on the airline businesses. Now, what happened was obviously we had a worldwide crisis, and basically the facts changed on that business. So it's highly likely that passenger miles over the next couple of years are going to be substantially down on what they were last year, for example. Whether they recover is yet to be seen. They probably will at some point. But regardless, the earning power over the next 10 or 20 years is probably taken a little bit of a hit. Now, that's one problem that happened with the airline business. The other problem is that they are very capital intensive businesses, and they also earn relatively thin margins. And as I've spoken about in a couple of more recent videos, when we have a combination of those two things, even a slight drop in revenue can make those businesses unprofitable. And when we have a substantial drop in revenue like we do at the moment, it means that those businesses can lose a lot of money very quickly, and either one of two things or two things can happen in that situation. Firstly, the company is almost certainly going to take on a lot more debt. And I'll talk through how to kind of think about that in a sec. The second thing is if it gets bad enough, the company can go bankrupt. Now, if you think the company is going to go bankrupt, the selling decision then becomes quite easy because you think that company has an intrinsic value of 0. If you can sell it for anything more than 0, it's probably a good decision at that point. So that makes the decision very easy for selling. What's trickier is if you don't think the business is going bankrupt, but they've taken on a whole bunch more debt. So if we think back to that original 7 or 8 times earnings that Buffett was paying, we've now had a drop in earnings. So let's call it that he's now paying, say, 10 or 12 times long-term cash flows, long-term earnings for those airline businesses. And we're also going to have to subtract some more out of those earnings to start to repay these mountains of debt that the company has taken out. So that might push the earnings multiple that we're effectively paying up to maybe 15 or 20 or even more than 20 times earnings, depending on how much debt this company has to take out. So that right there is a fundamental change in the original theory of the investment. And in this situation, Buffett just thought it best to sell. So if that ever happens, it's a hard decision to make. I've had to make that with one company in my investment lifetime ever, given my investment lifetime is only probably about 3 or 4 years at this point. But I have had to sell one business at a loss. And it was a tough decision. I mean, with the facts that were available to me at the time when I made that investment, I thought it was going to, obviously, I thought it was going to work out very well, or else I wouldn't have made the investment. But there was an event that came through which will probably impact that business for a number of years, and I made the decision to sell. So those are some of the reasons why I would look at selling a stock. It's definitely a much more complicated topic than buying a stock, in my personal opinion. But you've got to think rationally. Please don't sell a stock because you expect some market movement, or a stock is just down and you think it's going to go down further or something like that. Always relate these decisions back to long-term intrinsic value for the business, and that will basically give you the answer for you most of the time. So hope you enjoyed the video. If you did, please hit like, hit subscribe. You can watch some older videos over there. Hit subscribe over there, and I will see you in the next one. Cheers.